and Shibani Sircar Kurian also with us on the show. Shibani, what part of this nervousness will you attribute to the uncertainty regarding the portfolio allocations at the cabinet level? Or do you think whoever gets whatever in terms of the various ministries, it doesn't really change the prospects at company level, at the index level, and hence one should completely ignore the noise which is coming in from the political scene right now?
Hi, good afternoon. So our belief is that now that the elections and the verdict is behind us, it's back to basics and back to fundamentals. So for India as such and for the markets, if you look at the three factors that were driving markets so far are largely intact. One is the macroeconomic parameters are strong. Second, corporate profitability and as seen in for FY24 numbers as a whole remains fairly strong, and corporate profit to GDP has been on an uptrend. And the third is domestic flows continue to remain fairly strong. So from that perspective, markets are holding up well in terms of fundamentals. The other question that we often encounter is on valuations. Now, it is true that India, relative to the rest of the emerging market pack, is trading at multiples, which is at a premium, but that has always been the case. So if you look at valuations being at a premium, but also corporate profitability like GDP growth has been surprising on the positive, and you've seen the numbers come through, which have been a little bit stronger than what was earlier anticipated. Now, if you look at market segments, clearly the risk reward continues to be more favorable where large caps are concerned and some of the larger mid caps. So if you look at the Nifty is now trading at a slight premium to its long-term average multiples, while mid caps and small caps as an index level are trading at a significant premium to their long-term averages. So we are continuing to believe that the domestic-facing sectors are still very well placed. One has to be mindful of valuations. Look at companies where growth is intact but are trading at reasonable valuations rather than chasing momentum, and looking at companies where valuations are elevated.
Right, okay. Seems like some healthy consolidation on its course. But Kunal, does it seem like it could be an across-the-board pause? I mean, what about some of the select PSUs? What about FMCG and then private banks?
I think for PSUs, definitely it's a pause because, look at this way that if the indices had fallen down from 23,300 levels towards 21,300 odd mark, and we managed to recover almost the entire loss, PSUs have recovered just 50% of it. And I think most importantly, many of the PSUs, the likes of NTPC, ONGC, even the high beta ones like REC, PFC, etc., and many of the other names, they have recovered and they've come back to just the 50-day moving average and have not broken past about those levels, which means that there is a definite sign of underperformance, or the bounce is very weak into the PSU pocket. So I would believe that that could be a pocket which may underperform at least over the near term. And if you see some more signs of weakness into the larger cap names of the PSUs, we may actually expect many of these stocks to even correct by a margin of 5 to 7% broadly in the next 2 to 3 weeks. But I think FMCG, on the other hand, I think something which looks fairly attractive. So that 3 days, 2-3 days of strong up move for many of the FMCG names, HUL, etc., moving up higher, and then the stocks going to a pause for the remainder of the next 2-3 days, I think indicates that now these stocks have come back into a neutral territory in terms of indicators and charts. Would be bullish on FMCG.
Okay, the market for you at the bottom of the screen, wherein the Sensex has taken a tumble of almost 600 points from the high of the day, and the other data points regarding mid-cap and the Nifty will keep updating there, so keep your eyes out there because there's a definite slide in the markets. But Shibani, the first signature that actually the Prime Minister put on was that Kisan Nidhi scheme. Does that give you any insight as to what could be the favor of this particular government? Is it going to be a lot more rural and populist in nature? And if yes, does it warrant a relook in terms of the sector and the portfolio allocation?
So our belief is that if you look at government policy, and of course we'll get to know more in detail over the next few days and then going into the union budget, but the government in terms of policy focus would continue pretty much along the same lines as what was happening over the last few years, over their last term. They will continue to look at fiscal consolidation. They will look at possibly the investment-led growth path. A lot of debate, of course, has been happening in terms of consumption and what happens on the consumption side, especially demand at the bottom of the pyramid, which continues to lag the premium end consumption. Now, even before the elections and, the last time we spoke, our belief was that there are incremental, some signs of recovery where rural and mass consumption are concerned. It's a slow and steady recovery. It's not a fast pace or a very V-shaped recovery. And maybe some support coming in from government side would also help in terms of accelerating the trends. Clearly, as you know, that real rural wages have been stagnant over the last maybe 5-6 years, but incrementally a few pointers. One is that as inflation starts to kind of moderate, real rural wages should see some uptick. Secondly, the expectations of a normal monsoon translating into better Kharif output would also help in terms of rural incomes and farm incomes, and that's something that we will wait and watch out for. If you look at commentary that has come through, especially where some of the FMCG players are concerned, the bottoming of rural demand seems to be well in place. It's a question of time as to when we start seeing that demand start to improve, and maybe some nascent signs are already visible. So our belief is that from a valuation perspective, if you look at the sector is trading at multiples which are lower than its long-term average history. And if rural demand does start to pick up, you could see some momentum and valuations re-rate in the segment. So on the FMCG side, we have been incrementally looking at companies that can benefit from this trend.
Cement, in fact, is one buoyant pocket this morning. Just earlier today, we were chatting with Vinayak Chatterjee as well. While it's, of course, speculation has been rife around it that perhaps GST on cement may actually be reduced, but it seems that chatter is now getting only louder. Ramco Cement holding up 5.5%. You've got Shree Cement up 4.5%. Ultratech as well higher by 3.25%. Naresh, any trading opportunity after the move cement has already seen today?
So it's just a start of a move in a lot of names. So something like Shree Cements, which looks interesting, the stock has broken out of the last 3-4 months range, about the 26,800, 27,000 mark. This could go towards the 30,000 mark in the short term. Same way, there is a Dalmia Bharat Cement, which has corrected from 2,400 odd levels all the way to 1,700 and has made a classical double bottom formation and is giving a reversal. So there are names which are breaking out on the upside like Ultratech as well. So the whole basket looks interesting at current levels, but I would go with Dalmia Bharat and Shree Cements at current levels.
On that note, listen into what Vinayak Chatterjee told us, because he said that 28% GST on something which is for nation building is clearly unreasonable, and there has been increased clamour around bringing it down.
I think there has already been reasonably vigorous, shall we say, entreaties to the finance ministry even before the last 3 budgets, that the 28% GST on cement seems to be inappropriate, considering that it's an Aam Aadmi product, it's an infrastructure input, and taxing it at the sin road of 28% GST does not seem to be logical. So I am actually expecting in these 5 years, the 28% GST on cement to be reduced substantially.
Okay, point taken. So that's the view coming in from Vinayak Chatterjee. In the meantime, taking stock of some other buzzers as well. You have FACT or FACT, which is higher. RCF is also trending higher. And this, of course, is getting a fillip from the agri push that we have seen with the Prime Minister signing that Kisan Nidhi scheme today. Intellect Design is doing fairly well. Happiest Minds within the IT space is also standing out quite tall. And then you had this Jana Small Finance Bank, which has been doing quite well for itself over the last few days. In fact, there were a couple of analyst meets that happened over the weekend. Kunal, stocks like SIAT, Zensar Tech as well as MGL were in focus on account of the commentary that came by. Anything on the charts that you would recommend?
So SIAT is something interesting. Tire stocks, in fact, apparently many of the tire names, Apollo Tire, Balkrishna Industries, SIAT, these stocks are coming back into a recovery mode. I would not say a major breakout mode, especially for the likes of SIAT, because these stocks have been still trading low by their previous 52-week highs. I think 1560, 1600 was the previous highs for SIAT. And for these stocks have come back to their mild breakout points. But I believe that the likes of Balkrishna Industries is something which is very attractive. So the stock was one of the first ones to recover. I think the last week or the week prior to that, the stock had seen a good 10 to 15% rally from 2700 mark towards 3000, 3100. And then some choppiness around the 3000 levels, but the stock is again inching back towards a breakout at 3000 plus mark. So that's an attractive name to look out for. MGL, on the other hand, I would still be a bit iffy in terms of trading the stock, because of the way the stock is extremely volatile and choppy. Even today, for example, the stock opened with a gap up, but that did not sustain, and you've seen the stock selling from the intraday high level. So the fact that these stocks are a bit unsustainable when the stocks generally go into a sudden rally, I think makes the trade into these stocks a bit difficult.
Right, okay, on that note, we're going to take a very quick break. We've, of course, slipped sharply from the day's highs, but let's see how long it sustains, whether it stays here or whether this dip gets recovered and bought into. Back with closing trades right here in 80 now, 0.5% lower. That's been the kind of fall that you've seen from the day's highs. We're down about almost 62 odd points. 23,295 is where we're currently at. Actually, no, it got covered into. We're now down just about 30 points and nudging into the green. It's HDFC Bank, ONGC, Tata Motors, IndusInd Bank, Bharti to some degree, and even L&T. They're the ones which are flickering in and out of the red to the green. And I guess that's what's going to define the way the Nifty moves. Even Reliance, for that matter, that's also had quite a choppy ride today. And that also has been recovering, and that's, I guess, playing out on the index too. That too dipped in the red and now bounced back another 0.4% or so. Kunal, let's get a chart check on Reliance, L&T, some of the poster boys of last week's rally or recovery, whatever you want to call it.
They still look very strong. In fact, Reliance is the stock on the large cap name which is making an attempt towards the 3,000 mark for the fourth time in the last, I think, 1.5 or 2 months. I think in the month of March and April start is where the stock had started to get into that breakout around the 3,000 levels, and this is the fourth attempt for the stock to try and inch back towards the 3,000 mark. I believe that sooner or later, whenever the stock breaks past about the 3,000 level, we could be looking at a 150-point rally at least for Reliance Industries, and that's going to propel the index also going forward because of the high weightage. L&T is also an interesting case because the stock had fallen down significantly from 3,800 to almost 3,300, 3,400 levels, and it's now recovered almost 50% of those losses. I think even at current levels of 3,500, the stock still looks very attractive. And as a short-term play, I would look out for targets in the range of 3,700 to 3,750 for L&T.
Okay, point taken. Shibani, before we let you go, last question on the insurance sector, because that had seen a bit of a sideways move, but at a time when people are looking for value bets, does it warrant a look? Because my colleague Anurag will join us shortly and talk about the May data that has come in for life insurance. But clearly, the first tick suggests that it's a good growth coming in the month of May as well.
Yeah, so insurance has been a sector which has seen significant challenges over the last many years. One, of course, post-COVID, we saw impact on insurance companies because of mortality claims. Then you saw significant regulatory changes. Now, in fact, even now, one of the biggest reasons why sector is trading at multiples which are lower than their long-term averages is possibly because of the regulatory uncertainty, specifically that surrounding the surrender charge norms. Now, if you look at the sector, some amount of that growth in the sector appears to be coming back. That is reflected in the data that is coming out on a month-on-month basis. However, from a margin perspective, there has clearly been a shift away from products which are higher margin in nature, specifically the non-par segment, towards the ULIP piece, where because of buoyant capital markets, you've seen significant growth, where margins are lower than what it is in the case of non-par or annuity. I think for the sector, a couple of things are required for re-rating. One, of course, some amount of regulatory certainty come through, specifically on the surrender charge issue. Secondly, if you look at from a product perspective, growth coming back, specifically where retail protection is concerned, will be one of the key drivers for the sector. So as of now, we've been on a wait and watch mode, specifically given the fact that there is still some degree of regulatory uncertainty and pressure on margins because of the change in terms of product mix away from higher margin to segments such as ULIPs, which are lower margin in nature.
Okay, Shibani, great to have you on the show. We'll let you go on that note. Good having you on the show as always. But
if you like this video, then like, share and subscribe to ET Now.